Ask 10 different analysts how much money the 2026 World Cup is actually worth, and you'll get 10 different numbers. FIFA says one thing, independent banks say another, host cities say a third, and the gap between those numbers isn't a rounding error, it's the entire story. Here's the honest starting point. Depending on what you choose to count, this tournament's total economic footprint lands somewhere between $11 billion and $30 billion. That's not a typo, and it's not me being sloppy with numbers. It's that the World Cup economy actually means three completely different financial systems stacked on top of each other, and almost none of the headlines bother separating them. By the end of this video, you'll understand exactly why those numbers diverge so wildly, and more importantly, which one of them actually predicts where your money goes if you're an investor, a taxpayer, or a fan trying to figure out where the smart money is really flowing this summer. Let's build this the right way, layer by layer, starting with the foundation, FIFA's own commercial revenue. FIFA's four-year commercial cycle running from 2023 through 2026 is projected to generate roughly $13 billion in total revenue, with close to $8.9 billion of that tied directly to this tournament. Broadcasting rights alone account for more than $4 billion of that figure, spread across deals with networks and streaming platforms in over 200 territories. Sponsorship contracts with companies like Adidas, Coca-Cola, and Visa add another $2.8 billion. And ticketing and hospitality revenue, boosted by the jump from 64 matches to 104, is projected to come in close to $3 billion, a 216% increase over Qatar 2022. That's layer one. Call it the contract layer. This is money locked in through agreements signed years before a single ball was kicked, and it flows almost entirely to one organization, regardless of how any individual host city's tournament actually goes. Layer 2 is where the $15 billion headline number actually starts to make sense, and it's the layer most people never see separated out. Direct capital investment tied to the tournament. Unlike Qatar, which spent close to $220 billion building an entire country's infrastructure from scratch, the 2026 hosts are leaning on existing venues. Total stadium upgrade investment across the 16 host cities is estimated at around $1.5 billion. A fraction of what previous hosts spent, but still real capital expenditure flowing into construction firms, engineering contractors, and local labor markets. Add that $1.5 billion in infrastructure spending to FIFA's $8.9 billion in tournament revenue, layer in security funding, transit upgrades, and public safety budgets across host cities running into the hundreds of millions more, and you start approaching a combined figure in the $11 to $12 billion range just from direct contracted spending. Once you fold in projected hospitality and tourism spending on top of that, independent estimates start landing closer to $15 billion in total business activity tied to this single event, which is exactly why some analysts use that number and others don't. It depends entirely on whether you're counting FIFA's contracts, the capital spent building for the tournament, or the broader wave of consumer spending the tournament pulls in behind it. Layer 3, and the one that gets the most airtime in the press, is projected gross domestic product impact. And this is where the numbers start getting genuinely disputed. FIFA's own joint study with the World Trade Organization projects the tournament will generate $30.5 billion in total economic output and contribute $17.2 billion directly to GDP across the three host countries, supporting close to 185,000 jobs. That sounds enormous, and it is enormous until you put it next to the size of the economies it's landing in. For the United States specifically, a $17 billion GDP boost amounts to less than 0.1% of total GDP, genuinely a rounding error at the national level, even while it's a meaningful, visible bump in any individual host city. Now, here's where independent research starts pulling against FIFA's own projections. And this is the part of the story that almost never makes it past the press release. Analysts at the Danish investment bank Saxo, along with economists studying the tournament independently, consistently estimate real impact below FIFA's own figures. The core argument is something economists call displacement. A tourist who would have visited New York or Los Angeles anyway, World Cup or not, doesn't represent new economic activity. They're just timing their trip around the matches. A local resident who buys a $40 burger near the stadium on a Saturday isn't necessarily spending new money. They may simply be redirecting spending they would have made somewhere else in the same city that weekend. Research from Oxford economist Bent Flyvbjerg, who has studied cost overruns across decades of mega events, found that these projects regularly exceed their original budgets by an average of 172%, largely because a World Cup, unlike most infrastructure projects, has a fixed deadline that cannot move. When construction runs behind schedule, costs get absorbed at any price, and that bill typically lands on public finances, not on FIFA's balance sheet. This is the layer where the real investment thesis lives, and it's worth understanding if you're trying to think about this the way an actual capital allocator would, not just a fan watching highlights. Mexico is being flagged by multiple independent analysts as the clearest relative winner of this three-country arrangement. With an estimated $3 billion in projected economic benefit, that figure represents between 0.2% and 0.5% of Mexico's GDP, small in absolute dollar terms compared to the US number, but proportionally far more significant. Because tourism and hospitality carry much greater weight in Mexico's overall economic structure. Cities like Guadalajara, Monterrey, and Mexico City are positioned to feel that effect most directly through hotel occupancy, restaurant revenue, and short-term rental demand that doesn't require the kind of speculative infrastructure spending that turned Brazil's 2014 stadiums into long-term financial liabilities. That Brazil comparison matters more than most coverage gives it credit for. The Arena da Amazonia in Manaus, built for 4 group stage matches in 2014, became one of the most cited case studies in modern sports economics for exactly the wrong reasons. A venue that cost hundreds of millions of dollars to build and now sits largely unused, a textbook example of what economists call a white elephant asset. Enormous capital expenditure with no sustainable post-event revenue stream to justify it. The reason 2026 carries meaningfully lower risk on this specific front is structural, not just lucky timing. Every major venue in this tournament is already owned and operated by a profitable professional sports franchise, with an existing fan base and existing revenue streams outside the World Cup. The stadiums don't need the tournament to survive financially. That single structural difference is the clearest reason this year's hosts are unlikely to inherit Brazil's stranded asset problem. Now let's talk about where the actual short-term capital is flowing right now, because this is the layer with the most direct, measurable financial signal, and it's happening in real estate markets and host cities as we speak. Hotel occupancy in host cities is running significantly above seasonal norms. Projections point to occupancy rates above 95% during peak tournament weeks, with room rates in some markets running 200% to 300% above typical pricing. In Boston specifically, short-term rental occupancy for the group stage was tracked at 47%, compared to just 26% during the same period the previous year, nearly double the baseline demand. Airbnb has gone as far as offering incentive payments of up to $750 to encourage first-time hosts to list properties in host markets, a direct signal of how much short-term capital is being deployed to capture this temporary demand spike. Rideshare platforms are projecting 3 to 4 times normal demand in host cities on match days. None of this requires owning a stadium or signing a sponsorship deal. It's simply liquidity chasing a predictable, time-boxed surge in consumer spending, and it's a pattern worth recognizing because the same dynamic shows up around any major event with a fixed calendar and a geographically concentrated audience. Super Bowls, Olympic host cities, major election cycles, and swing state media markets. The capital doesn't care about the sport, it cares about the predictable spike. But here's the honest counterweight, because a one-sided bull case isn't a financial analysis, it's a press release. Demand signals coming into this tournament have been weaker than initial forecasts in several measurable ways. A survey of more than 200 hotels across the 11 U.S. host cities, conducted by the American Hotel and Lodging Association, found that nearly 80% reported bookings tracking below their original projections. Cited reasons include visa friction for international visitors, elevated geopolitical tensions, and ticket and travel costs that have simply priced out a meaningful share of the audience FIFA originally modeled. Some hotel operators in the survey went so far as to describe the tournament's impact in their specific market as a non-event. International visitors traveling on visas from several qualifying nations are now also required to post bonds ranging from $5,000 to $15,000, decided at the visa interview stage. A friction point that didn't exist in earlier projections, and one that's almost certainly suppressing exactly the high-spending international tourist segment the original $30.5 billion projection was counting on most heavily. So, if you're trying to build an actual financial framework out of all of this, instead of just watching the matches and assuming the headline revenue number means something simple, here's how the layers actually stack. The contract layer, FIFA's broadcasting and sponsorship revenue, is the most predictable and the least exposed to execution risk. It was locked in years ago and barely moves regardless of attendance, weather, or any single match's outcome. If you're thinking about this from a pure capital flows perspective, this is the closest thing to a fixed income instrument in the entire tournament. Contracted, scheduled, and largely insulated from variability. The infrastructure and capital expenditure layer, stadium upgrades, transit investment, security spending, behaves more like a public infrastructure bond. The capital gets deployed up front, the return is diffuse and long-dated if it exists at all, and the downside risk, as Brazil demonstrated and as Flyvbjerg's research on cost overruns confirms, sits almost entirely with the public sector that financed it. The consumer and hospitality layer, hotels, short-term rentals, restaurants, rideshare, is the closest thing to a pure short-duration trade. High predictable demand, a fixed and known time window, real capital actively flowing in to capture it right now, and genuine downside risk if demand underperforms relative to inflated pricing, which the hotel survey data suggests is already happening in a meaningful number of markets this summer. And the GDP and broader economic impact layer, the $17 billion, the $30 billion, the headline numbers in every press release, is the least reliable for actually predicting where money goes, because it's the layer most vulnerable to displacement effects, optimistic modeling assumptions, and the structural incentive every host city's promotional economic impact study has to produce an impressive number, regardless of how that number eventually compares to reality. None of this means the World Cup is a bad investment for the cities hosting it, or a scam being run on host countries. Some of the economic case genuinely holds up, particularly in markets like Mexico, where tourism plays an outsized role in the broader economy. What it means is that the World Cup is a $15 billion business is true, and also almost meaningless on its own, because that single number is actually four different financial systems wearing one headline. The contract money, the capital expenditure, the consumer spending, and the projected GDP impact all move on different timelines, carry completely different risk profiles, and land in different pockets entirely. FIFA's, the construction sectors, the hospitality industries, and the broader economies, in roughly that order of predictability. The next time you see a headline economic impact number attached to any major event, a World Cup, an Olympic bid, a new stadium proposal in your own city, the question worth asking isn't whether the number is real. It's which of these four layers that number is actually describing, and which layer is conveniently being left out of the press release.